Hey, hi everyone. Welcome to another video. And As a part of our option selling adjustments positional trading series. So today we are going to go through put ratio spread adjustments, positional trading in Indian options, index options markets, and we will go through specific scenarios and examples from Nifty, Sensex, and Bank Nifty, and each adjustment examples we will go through. So this is a positional put ratio spread trade and adjustments for Indian options markets, index options markets, right? So what is the put ratio spread? Put ratio spread is typically a bearish to neutral strategy. That is when you take a put ratio spread. It's a directional strategy. So you when your view is bearish to neutral, then you take this put ratio spread. You buy one ATM put. So you buy one ATM put and you tell two OTM puts of the same strike lower than the buy. So that's what a put ratio spread is. And your view is you're expecting moderate downside, not a crash. Okay, advantages are it can be entered for low or even zero net cost, and the profits could be made if the market drifts lower towards the short to put strikes. Risk is unlimited. Downside risk is there if market crashes below short puts. Okay, so then the adjustments, if market stays sideways and falls slowly towards your short put strike, that's an ideal case. So your short puts will decay and long puts gain slightly. Okay, so that's the ideal case because your view was slightly bullish, right? Slightly bearish, and the same thing is happening. Market is sideways and it's falling slowly, so your short puts will decay and your long put will gain slightly. Okay, so what you do in this case, you hold till the theta works in your favor. So and when profit reaches 60 to 80%, you close the trade. Okay. The other thing you could do is you could roll down the short puts. So example, Nifty is at 20,000. You bought at 20,000 PE and you sold 19,800 PE two lots. So Nifty falls to 19,850. You roll that 19,800 PE to 19,700 PE by sell 19700p two lots there. Okay, or you could also do a conversion to a bear put spread. You could do, you buy back one of the shorted PE, then it becomes a bear put spread, and then it reduces your risk, basically crash risk. It reduces and it basically makes it a hedged position, and also a risk and reward defined position. So next case is market falls sharply below the short put strike. Okay, so your short put, you are in unlimited risk zone now, and your short puts are deep in the money now. So what you do is you buy back one or both short puts to cut down the downside risk that you could do. So you buy back the short puts because those are broken already, so that you cut down the downside risk, or convert this to a broken wing butterfly. So add one long lower strike put to cap loss. Okay, so Bank Nifty is, for example, Bank Nifty is at 45,000. You bought 45,000 P and you sold 44,500 P two lots. Then you add one 44,000 P. Okay, so that would make it into a broken wing butterfly. Okay, so broken wing butterfly adjustment also you could do if market falls sharply below your short put strike, or you could just buy back the short puts, or you could do roll down and out. You close all the existing the losing shots and resell at lower strike points for next expiry to recover part of the loss. The third scenario is market rises away from your long put strike. So you have bought a put also. So market is rising from that long put. So that put will lose value because of theta. So and short puts will gain slowly, but this put will lose value quickly. So adjustments you could do is you could close early and re-enter higher. So you could just close this position and you could re-enter this. You could put this entire position at a higher strike. You could sell an OTM call, convert this into a short strangle for extra premium. You could convert into calendar put spread also. Okay, so you close this position and convert into a calendar put spread. Sell current month put, by next month same strike put to benefit from faster near month decay. Market rises sharply far above all strikes, then your entire structure loses value. Main loss from bought put to decay. Then you close and exit that position to avoid decay loss. You switch your view and convert your view from bearish to bullish and take a bull put spread and change your outlook from bearish to bullish. Or if your view is still bearish only, re-enter at higher strikes closer to the market price. Okay. Example of Nifty is 20,000 PE you bought and you sold to 19,800 PE two lots and it credit is 10 rupees. Market falls slowly to 19,820. You basically make money and you can roll the shots from 19,800 to 19,700 PE. Market falls sharply, so it broke your 19,800 PE and it fell to 19,600. Then you buy back one 19,800 PE and add 119,400 PE. Okay, or market rises to 21,050. Okay, then you sell 2,400 C to collect extra premium. So that's what you could do. So these are the different adjustments. So yeah, you could convert to a broken wing butterfly when falls sharply below your short put strike, and market rises when market rises away from your long put strike. You can convert it into a calendar put spread, okay, or convert it into a short triangle. If it's in your favor, then just hold it and take the profit, or and put new one in the roll down the entire put ratio spread for a roll down the entire put ratio spread, or you could convert it into a bare put spread to reduce crash risk. That's it for today, guys. Thanks everyone. Have a nice day. Bye.